Assalamualaikum warahmatullahi wabarakatuh to our lecturer. Today, I'm Muhammad Syahdan Bizukifli from TBA 2723A. I'm going to talk about capital structure with my teammates. So, before we go over there, let me introduce my teammates. First, we have Muhammad Adlan bin Muhammad Noor. Second, we have Nu'man Shazwan bin Nazri. Third, we have me, Muhammad Syahdan Bizukifli. Fourth, we have Muhammad Kushairi Firdaus bin Zahari. And for the last, we have Ahmad Muiz bin Muhammad. So, let me continue with the table of content. For the table of content, we have introduction, affecting capital structure, decision-making process, theories of capital structure, agency problems and cost of equity, and for the last, we have signaling hypothesis. Without wasting any time, let's start with the introduction. It is the capital structure that determines how a company finances its operation and growth with the help of different sources of fund. For example, we have debt, equity, and hybrid securities. This balance between the debt and equity funding determines the financial health of any company, as it impacts the risk level and cost of capital along with overall value. In our presentation, we will elaborate on how the major components of capital structure, debt, equity, and hybrid financing progressive prove a mix necessary to sustain a growth and achieve financial stability. The notion of capital structure can assist in decision making by companies in devising strategies that conform to their objective while optimizing costs and handling risk with due diligence. We also learn from this overview how businesses can build and sustain their financial foundations.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Adlan bin Muhammad Noor from TBA 2722A, and I will explain about the factors affecting capital structure. So the first one is tax. In many tax systems, the interest payments a company makes on its debt are tax deductible. This means that interest expenses reduce from company taxable income, thereby lowering its tax liability. This tax deductibility makes debt financing more attractive because it reduces the effective cost of borrowing. When a company can save on tax by using debt, it effectively saves more money that can be distributed to shareholder. The second one is type of assets, which I took liquidity asset. Companies with highly liquid asset can use more debt since they can service debt obligations more easily if needed. In contrast, companies with more illiquid assets, for example like real estate, might limit debt used to avoid cash flow issues that could arise if they can't quickly liquidate assets. The third one is uncertainty of operating income. Companies with predictable operating income are more likely to use debt in their capital structure, as they can service debt consistently. However, if a company operating income is uncertain, it faces greater financial risk with debt, making equity financing more attractive and safer option. Last but not least, the fourth one is pecking order theory. According to the pecking order theory, companies tend to prefer internal financing, which is return earning first, then debt, and only issue equity as a last resort. This is due to the cost of asymmetric information, which managers may have better information about the company's value than the external investor. So, they prefer to avoid issuing equity unless it is necessary.
Decision-making process. How firms establish capital structure? First, companies don't use a lot of debt. Most companies prefer not to borrow too much compared what they own, which means less debt, more equity. Example, a supermarket chain in Malaysia like Maidin might keep debt low to avoid financial strain. This is especially important if the economy slows down and few bigger shop there. Second is borrowing money can change a company value. When a company borrows money, the stock price can sometimes go up, which means bigger profit for investor. A company gets that benefit by writing off the interest they pay on the loan. Taking more debt can also signal to investors that a company is confident of their future. They give me example like Petronas. Borrow to expand a operation. If investors believe what they do, they will gain more profit. Third is different industry use different amount of debt. Some industries like utilities can use more debt because they have predictable income, while other like tech startup avoid it because their income is less certain. Example in Malaysia is Tenaga Nasional Berhad (TNB). As Malaysian energy provider, TNB has stable income, so they can use more debt for projects like building power plant. Second example is Carsom, a tech startup in online car selling industry. Carsom will likely use less debt because their profit are not predictable. Lastly, companies have a goal how much debt they want. Companies try to keep balance between how much they borrow and how much money they get from investors. This balance helps them stay safe and make money. If they have too much or too little debt, they make adjustment to get back of their target earnings. Example is company like Topgolf, where they making a glove, might have target how much debt they want compared to their earning. If they borrow too much, they might slow down or take a new loan or pay some of debt back. This way, they can keep a healthy balance that help they grow without too much risk.
So, as for my first subtopic called theories of capital structures, from what I have learned in the subtopic, there are 6 theories contained in the subtopics. So first of all, the Modigliani-Miller theorem, also known as the MM theory, presents a model of some assumptions where the value of an unlevered firms are equal to a levered firms. That means that investors can use it as to calculate the market value of the firms. Then secondly is a trade-off theory, where the trade-off theory of the capital structure refers to the firm choices of how much the debt finance and also the equity finance it wants to use as equilibrating the cost against the benefits of a company. Then we also have the pecking order theory. The pecking order theory orders its sources by financing and finds equities finance as their last resort. Then for the agency cost theory. Agency cost theory also associated with the separation of interests between the shareholders and also the management teams. Then fourthly, the market timing theory. The market timing theory also suggests that the firms issue equity when the equity is overpriced and restrains from repurchase the equity when they are undervalued. Then lastly, it is a signaling theory. Signaling theory assumes information asymmetry in a market according to the financial health of a firm, meaning that it is not available at the same time everywhere for its market value. Okay, let's move on to another subtopic, agency problems and also the cost of equity. First, the agency problems is in our capital structure. In finance, refer to various conflicts of interest between the management and also the shareholders. In the management tends to act as an agent for the shareholders so that they can gain their personal wealth rather than improving the company's benefits. So, the profit received by the firm, stock price, and also shareholder goodwills can be affected by our agency problems, such as the company budget planning, employee schemes, non-monetary incentives, and our following accounting principles. Then, let's move on to our cost of equity. Agency cost of equity is considered conflict of interest arising between the management and also the shareholders. When the management makes decisions that may not be the best interest for the firm and also the shareholders, as an actions that will not increase the value of their shares, there is a problem in a agency cost of equity.
Assalamualaikum, my name is Ahmad Isbi Muhammad. I'm from TBA 2723A and I will explain about signaling hypothesis. In accounting and auditing research, signaling theory has been widely applied. It suggests that management may convey information about the company through different financial information disclosures, which investors may interpret as a signal. The timelines of earnings is one of these disclosure requirements. As everyone knows, firms with low anticipated profits will take on a low level of debt. Meanwhile, firms with high anticipated profits will take on a high level of debt. A manager that takes on more debt than is optimal in order to fool investors will pay the cost in a long run. The firm's capital structure is optimized where the marginal subsidy to debt equals the marginal cost.
In conclusion, capital structure is a crucial choice for business since it has a direct impact on overall stability, development potential, and financial risk. A company's long-term objective, market conditions, tax implication, business risk, and profitability all influence the combination of debt and equity financing. Finally, the objective is to reduce the cost of capital while controlling risk and ensuring there are enough resources for growth and operational needs. Capital structure decisions should be adaptable when market condition and business circumstances change. That's all from us.